So once again, we are welcome to this session of the accounting business module. Now, what we are looking at this time round is to focus on three main chapters in the recommended text. Okay, so we are looking at principally chapters number 12, 13, and 14. Okay, so we're looking at laws and regulations that govern the accountancy profession or the accounting practice. And then we're looking at the functions of accounting and finance within business organizations, then the financial systems, and then procedures within any organizational setting. So in the past, we've looked at various dimensions in terms of our discussions. We look at businesses and how they operate within their environments. Okay. Now the question is, to what extent does accounting play a role in any business organization? So, like I said, you can find this in the recommended text covering three different chapters. Okay. So let's now move on and see what role does accountants and then the accounting practice play within the larger business organization. Okay. So accounting function covers quite a number of items. It covers financial accounting, management accounting, audit and assurance, and of course, financial management. So financial accounting deals with control and stewardship, reporting to those within and outside the organization, but mostly they focus on stewardship, okay, to those outside, external. Management accounting is more of internal for organizational leaders and managers to take decisions within the organization. And of course, sometimes it impacts the external processes or activities of the organization. And financial management is typically looking at how we can raise funds, whether internally or externally, in order to survive as a going concern. And audit and assurance looks at the issues of evaluations or independent attestations. Sometimes the independence could be impaired, but it all talks about attestation, engagement, and evaluation, monitoring and evaluations of the organizational activities. So in terms of operational hierarchy, we normally have the board of directors at the top. The finance director, some texts will use chief financial officer, CFOs, but let's choose financial director or finance director for our context. They report to the board. Okay. Under the finance director, we have the treasurer, the financial controller, and then the management accountants who work with their colleagues, with their subordinates, the cost accountants, the bookkeepers, the accountants, and then the cashiers, okay, to ensure that they provide sound financial administration within the organization. Independently, we have the audit committee. They oversee the internal audit function so that they ensure that the activities of the internal audit function is independent and they report directly to the board. And you've realized in the past, we said these audit committees are made up of NEDs and then executive directors. Okay, now let's take a deep dive into the financial accounting. Typically, we know what accounting is. It's all about recording, classifying, interpreting, and reporting these financial transactions in monetary terms, in line with established standards, concept, accounting practices, and most especially in line with what? Reporting frameworks, okay? The main work of financial accounting is to report to external folks outside the organization, external stakeholders, okay? Yes, sometimes internal stakeholders also use financial accounting. We'll look at that as we proceed. Okay, so the regulatory frameworks, normally in terms of reporting, they're looking at the Companies Act. Companies will also have to keep proper accounting records and prepare these financial statements that show true and fair view of the organization's activities. Okay, these accounts, financial accounts, are usually audited by independent external assurers. Okay, and they ensure that these audited accounts are filed with the Companies House for compliance purposes. Okay, this is the UK law. These are the requirements by the UK law to ensure that reporting frameworks operate. Okay, again, accounting concept that regulates the reporting practice ensures that we must report objectively and get rid of any biases or subjectivity. Okay, now in terms of standards, a number of standards regulate accounting practice. We can look at the SAPs, the FRS, and then the IFRS, okay, International Accounting Standards and then the IAS, and of course, there is the quest or the call to ensure that we harmonize the IAS, the International Accounting Standards, and then the International Financial Reporting Standards. With the European Union, when UK was part of the EU, all companies, especially those listed on the stock market, are required to comply with the IAS. Currently, we don't know what is going to happen in the future, but of course, most companies or all companies listed on the stock exchange in the UK tend to prepare their accounts in line with either the IFRS or IAS or both, okay, for compliance purposes and for listing requirements. Let's look at external financial information and how they report to these external folks or external stakeholders. So externally, you can talk of the shareholders, the banks, the suppliers, or the government at large. External reports are normally historical. We know accounting information is always giving us information about the past. So it's all about historical information. The users, like I said, it covers both internal and external folks, but mostly we normally say financial accounting is for external, but it covers both internal folks as well. So managers of the organization, shareholders, suppliers, and customers, managers are internal stakeholders, okay? Shareholders, suppliers, providers of finance. Remember, we had stakeholders split up into what? Connected, internal, and then external. Suppliers are connected, okay? So more or less, financial accounting cuts across every aspect of the stakeholder groups, okay? Talk of the revenue collection agencies, HMRC, okay, employees are internal, financial analysts, government agencies, and then the public at large. These folks or stakeholders need financial information for informed decision purposes. Three main accounts characterize financial accounting practice, and these are profit and loss or statement of comprehensive income or the income statement. The income statement or profit and loss looks at the financial performance of the organization. Then we have the balance sheet or statement of financial position. As the name sounds, it's look at the financial position of the company at a certain date, okay? The income statement normally covers a period of operation, normally a year. But the statement of financial position looks at the position, the standing of the organization at a particular date, okay? So it normally will try to detail out the assets, the liabilities, and then the capital at the end of the trading period. Then we have the statement of cash flows, which looks at the cash we receive and the cash we disperse. And this one deals with typical liquidity, okay? There is also one more statement which has to do with changes in equities, but of course, it will fit into the balance sheet. So normally, we normally want to classify it as part of the statement of the financial position. And all financial statements will usually come with supporting notes to the account, which is required. This is a question, try to see if you can get them, okay? The question is simply asking you, where can we find these items, okay? Where can we find these items? Where will we find the ratio of current assets to current liabilities? Is it in the income statement or statement of financial position? All right. Where can we find total shareholders' equity, gross profit as a percentage of turnover, total rent paid? Okay, so try and work it out. Okay, of course, you can get the solutions posted here. Okay, but you can still ask yourself, where can I find these items? All right. Financial accounting will not be complete if we don't record transactions. So we need to always record the transactions using the right source document, okay? Like the invoices, the checks, the GRNs, good received notes. And of course, we must record them in the day books, the sales and purchases day books, sum them up and post them to the general ledger using double entry practices. And then also we try to adjust them at the end of the year. At the end of the year, we then try to publish this or consolidate them into our financial statement, which we mentioned previously. So the profit and loss, the balance sheet, and then the cash flows. Accounting systems, in terms of controlling the resources and accounting for all the activities of the organization, runs through a number of systems. We have the cash and bank system. We have the wages and salaries system, payroll. We also have the purchasing. And of course, we sell. After which we also have some fixed assets which helps us to run operations, okay, both from production or from service provision angle, okay. Now let's take these systems one after the other. The cash and bank system. When we talk about the cash and bank system, we are talking of inflows of cash. Currently, we don't normally exchange cash in most business transactions. It is all about company checks being written using the banking system or internet transfer systems, direct debit, and standing orders, okay? But regardless of this, we should know that still there's some form of cash being channeled from one source to the other. So we're looking at the cash, controls over the receipts, the payment, to avoid theft or fraud, okay? Cash is always the lifeblood of the organization. Without cash, the company is dead. You can be making profits, but if you don't have cash, remember, profit is not the same as cash. You can be making losses, but you should have cash. And if you do that, if you don't have cash, your company is dead. All right, liquidity is key. Receipts, any money we receive, let's bank them promptly. Don't keep them overnight, especially when they are significant, unless you are channeling them through the Impress system. Any recorded amounts should be referenced accurately to the supporting documents and ensure that losses are blocked off. No theft, no embezzlement, no accidental theft. Any accident should be blocked off. In terms of payment of cash, there should be strict controls. What evidence do we use to support payment? If you're paying salaries, do you have timesheet to support? Who is authorizing the payments, okay? And of course, not everyone should make payments. Some authorized individuals who have been mandated should be paying these amounts into the cash account or into the bank account at the end of the day. We must always reconcile our bank statement to our cash book and also perform some surprise cash count in terms of reconciling our petty cash to the activities or the disbursements which have been made. Let's look at the payroll system. This one normally run through both the HR and then the finance, okay, and then the departmental heads, okay. So for the payroll system, it's looking at paying wages and salaries accurately and producing pay slips to support it. Okay? If we need timesheets, we need to accurately get them to ensure that the figures reconcile or they jive with the number of manpower hours or labor hours which were exerted. So with the payroll system, it's looking at authorization of staff changes, are new guys coming in, are people leaving, okay? What is the rate of pay, any promotion, okay? And the calculation of the salaries and wages using the hourly rate, if that's what we are using. And also any deductions, statutory deductions, who is authorizing them? When do we also pay? It's also important. So controlling wages and salaries is key. We must work with the HR department, like I said, in establishing pay scales, allowances, and paying bonuses and commissions, and also knowing which amounts to deduct and which amounts not to deduct. Okay. Now we must also work with the departmental leaders. Like I said, they must sign off on the timesheet and say that, yes, Mr. A requires to be paid X amount because he's worked for it. And then with the banks, we work with the banks since it will normally be bank transfers into the employee's bank account. So we need to work around these areas. So in certain wages, what are the controls? In certain wages and salaries, what are the controls we need to put in place? Employees must be paid for only work they've done. And gross pay must be calculated correctly and authorized using the appropriate scales. How do we record wages and salaries? Gross and net should be recorded accurately in the payroll system. Wages and salaries should be paid directly, which have been paid should be recorded in the cash and bank records. Okay, wages and salaries must also be then be posted into the general ledger. If there are any accrued wages and salaries, we need to capture them as well. Okay, payment of wages and salaries, pay employees correctly, and then any deductions, statutory deductions, taxes, NI, make sure these are calculated correctly, and then shown, it must appear on the pay slip to ensure that the employees are satisfied that this amount of money has been deducted for tax purposes or for insurance purposes. Then we have the purchasing system. We buy. Even if it is a service organization, we still buy. Okay, so we buy. It's an important thing. We buy and we trade with it. Okay, so we must ensure that we only buy authorized purchases. Don't buy anything at all. What are the main stages? We must order, we must receive the goods, we must account for it, and we pay. These are the main stages involved. So ordering, receiving, accounting, and then payment. Take note of this. All right. So we need to provide control activities or control measures over the purchases, okay, to ensure that we are ordering the right amount of goods into the organization. We work with the purchasing department to ensure that we order the right quantities per descriptions and then the prices. If there are any discounts, we need to take them. And also liaise with the warehouse units to ensure that the goods we have received comply or conform with the orders we have made. And of course, at the end of the day, we pay. Okay. So there's always a three-way match. The order, the receipts, and the payment must all reconcile. So make sure that the order we have placed, the actual goods we get, we receive, and then the payment we make all reflect the same amount, the same quantity, and the same quality. All right. So otherwise, block off any payment. If we are receiving less than what we have ordered, we cannot pay for what we have not received. Okay. Now, the control procedures for ordering. Only certain individuals should be allowed to authorize orders. Authorization limits should be set, so there should be threshold up to 10,000. The departmental leaders could order. Anything exceeding 10,000 should be referred to perhaps the purchasing manager. Anything above maybe 20,000 should go to the board for approval. Okay. So purchase order must also be authorized. Any purchase orders must be authorized by appropriate personnel and order from authorized suppliers, only suppliers we know we can trust, not any ghost organizations where we cannot trace them. Okay. Now, again, for the goods received, we must always examine the goods for quantity and then the quality. Is this what we ordered for? Once they arrive, the goods arrive, we need to record them. If we accept them into the warehouse, we need to record them. Compare the goods received notes to the purchase order, one part of the three-way match, okay? Is this what we really ordered? Okay. And then if there are goods which were defective and we've returned them, we need to record as well. Are there any credit notes we've received, any discounts? We need to also reconcile it to the order we placed and the goods we have received. Okay. What about accounting procedures in terms of payments? There should be clear-cut segregation of duties. The one who is paying should not be the same person who ordered. The one who is receiving, in fact, should not be the same person who ordered. We try to see some kind of appropriate segregation of duties. Who is recording the purchasing and return should be not be the same person who is receiving the goods. So, like I said, always try to reconcile the purchase ledger and to the control account, the bigger picture. So we don't normally pay on time. Sometimes we pay over time. Okay, we pay over some period of time. So there must always be the control account, which will help us to control what we have paid, what we are owing, what is outstanding. And then at the end of the day, we should always reconcile the supplier statements to the purchase ledger to ensure that the X amount of this is actually X amount we owe to the suppliers, and authorize payments appropriately. If there are any year-end accruals, let's provide for them, okay, to ensure that we are recording the right items. Okay. Now let's proceed with the next step. Check supplier invoices, the quantities, the discounts, and ensure that they all jive. Perform a three-way match as appropriate as possible. Okay. Perform a three-way match. So a question is asked, try to order this in terms of which comes first and which comes next. Okay. Which order would you perform this? Very easy, right? So try and work out that question on your own. The sales system we sell, okay? What are the processes in the sales system? We're looking at selling, authorization, who is fixing the selling price, goods outwards, custody, and then accounting. And of course, we receive cash when we sell. So we work with the sales department and work with credit control. We sell, sometimes we provide credit facilities to the customers that pay 10% of the amount that you are owing in the next 3 days, and you get this discount. Okay, so we need to also work with the credit control to ensure that discounts which have been applied and credit limits are not breached by the customers. Okay, what about the controls about sales? Ordering and granting credit, like I said. So look at the credit rating of customers, record the orders appropriately. Once everything is okay, dispatch the goods, invoice the customer. So dispatch it accurately, invoice the customers. If there are any credit notes for any valid reason, indicate it. If there are any discounts, indicate it, okay? After which we must now record an account for whatever we have dispatched to the customers. So all sales invoices must be recorded, any credit notes, any discounts, and if there are any doubtful debt, which we know we cannot recover, we need to also record those ones. And of course, this will help us to determine whether we should continue selling to a particular customer who keeps defaulting or not. Okay. Pause for a thought. Ask yourself, what could happen if a company fails to abide by the legal requirements to keep proper accounting records? Normally, for financial accounting, we have bodies like ACCA, ICAS, and ICAEW, which regulate the practice or the profession. Let's take a deep dive into management accounting. Okay, just an introduction. So for management accounting, they are providing information for managers to undertake internal decisions. Okay, so mostly the information is for internal only. And so they could take forms like monthly management accounts, cash flow forecast, budgeting, okay, departmental budgets, and they should be presented in a way we think is feasible. It makes sense to us. There's no format like a profit and loss account and balance sheets and cash flows. In a very reasonable way, you just present it just to make meaning. Okay. Now, what does it involve? Planning, like making budgets, okay, forecasting, so that we can know which resources to allocate to which department. So that's one key thing there. So like I said, in terms of drawing our budgets so that they will make decisions, it also deals with making decisions, okay, assess, model, and ensure that cash flows implications of the organizations are well or streamlined to ensure that we are taking the right decisions. And control, monitor performance, try to perform some variance analysis, compare actual against budget, and try to see whether we were within or we fell outside. And also, in terms of monitoring, it helps us to set like a benchmark against which we can measure previous performance against future performance. Okay, so we monitor performance of segments, of businesses, of the department, of product performances, of services, to ensure that we do not repeat same mistakes or to even take corrective measures to seal off those gaps. Okay, and of course, CIMA is the well-known body that regulates management accounting practice. They've met with the American AICPA, so it is a great move in the right direction. Let's try to compare some of the differences. Okay, let's try to see the differences between financial and management accounting. So financial accounting is defined by the Act, okay, by the Act. Management accounting, there's no legal format. Timing is defined in terms of financial accounting. Prepare it at the end of the year, file your accounts 3 months after your year end. There's no legal timing for management accounting. Financial accounting must comply with the IAS, IFRS. There are no accounting standards for management accounting. Financial accounting is all about historical data, past information. Management accounting is forward-looking, future. Okay. Financial accounts are produced annually, sometimes semi-annually. Management accounting accounts can be prepared daily, monthly, weekly, fortnightly. Historical information, like I said, deals with financial accounts, whereas management accounting deals with forward-looking current information, future items. Financial accounting is mostly for external purposes, whereas internal use of information deals with management accounting practice. We don't need any board of directors to approve our management accounts. Neither do we need any auditors to approve our internal management accounts. But for financial accounting, yes, they must be approved by the board of directors or the directors, and they must be approved or signed off by external auditors to show that they represent a true and fair view. The question is, which is more important to managers within an organization and why? Within an organization and why? Is it the annual statutory accounts which have been approved by the directors and auditors or signed off by the auditors? Or is it the monthly management accounts which is approved by nobody? Which of these do you think is important for managers within an organization? Okay, financial management, how to use funds, where to get funds to run the organization. So it's all about funding decisions, investment decisions, investment dividend decisions, okay? And then working capital decisions. Where do we get money to run and to support our organization as a going concern, to invest? Okay, now we could use internal sources. And what are some of the internal sources? A number of approaches could be used. Okay, for example, sell stock holdings to raise some cash or tighten customer credit control. So instead of giving them 30 days to pay, give them just 15 days to pay so that I can get more cash. What about suppliers? If we are taking 30 days to pay suppliers, why not extend it to 60 days so that we can have surplus cash to run the organization? If we have any asset we are not using, scrap, sell the surplus assets so that I can make some money. And then the profit we make at the end of the year, instead of paying all of them as dividends to shareholders, use some, or sometimes don't even pay dividends to shareholders at all, reinvest these amounts into the organization. External sources, we can go for listing. If we are listed on the stock market, we can go for listing. We can go to the stock exchange to raise money, or the alternative investment markets to raise long-term cash. Okay, new shares, rights issues, corporate bonds can be raised on these markets. We can also acquire medium to long-term bank loans, okay, and also arrange some short-term bank overdrafts which are repayable on demand. Government grants could also help us to run an organization. It's a form of an external source of funding. And also the local authorities could also give us loans, all right? And interestingly, we can have venture capital funds we can access, or business angels can come in and give us so much money to help us run our business for some share of profit at the end of the day to them, okay, to the business angels. Now, the question is, how should the business finance its long-term funding? Long-term, by the shareholders, the owners, yes, and also so they can raise new shares or rights issues could be issued to them. We can retain our earnings instead of paying dividends, okay? We can also go for loans, loan capital, other people's money. So go for long-term loans, go for government grants, go to the banks, okay? The gearing ratio will normally determine the amount of loans we have as compared to the total equity holdings, okay? So the ratio of the loan capital to the total capital. Now, there are some implications. If we have a low gearing, it means that majority, more than 50 of the funding is supplied by the shareholders. But if we have a high gearing, it tells us that our company is technically owned by external capital providers like the banks who have given us loans. Okay, what are the implications if we have high gearing? High gearing, it means we can borrow at lower rates, 7%, to generate good profits, which will help enrich the shareholders. But the disadvantage of high gearing is that we may not be able to raise more funds, external, or acquire more loans when we need it. Okay, so both ways, there are complications. How should a business finance its short-term? Use working capital internally, okay? Use the credit cycle. Company pays goods on credit. If you can extend the credit time that you used to pay your suppliers, extend it, okay? Pay workers on hourly basis, pay salaried workers on credit monthly, pay them 1 month in arrears, okay? And the question is, how long should the company grant credit to people we sell to? Is it 30 days or should we reduce it to 15 days? Okay, or we should extend it. All right, so these are good areas we'll look at. Now we'll look at internal audit and then external audit in the next session, but let's just take an overview. So internal auditors are normally part of the organizations. They are hired by management, but for independence purposes, they report to the audit committee. External auditors, they are not employees of the company. They are independent professional accountants in practice, okay? So normally accounting, financial accounting statements are audited by these independent folks in line with the act, okay? And they must be registered auditors. They are always regulated, okay? And they must prepare an independent report which tells us whether the organization's reports reflect a true and fair view of the organization. And of course, some of the opinions will be modified, unmodified, adverse, so on and so forth. Most organizations, in fact, not most, all organizations want to get their accounts being unmodified, unqualified reports, clean reports. That's what it means, okay? We'll look at that in our next session, like I mentioned. So audit and assurance is a whole thing on its own, which will be our next point of discussion. So that's good, that's great. The role of accounting is very important in any business organization. Without accounting, there is no need for us to operate. You just want to operate without providing some controls to ensure that whatever you are doing reflects some monetary value, okay, value to the organization, value to stakeholders, value to everyone. Accounting comes in. So we can never do away in any organization, we can never do away with accounting if we want to survive as a going concern. Great. Thanks and see you in the next session.